That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs.
For years, silver has played second fiddle to gold, sleeping through headlines while gold steadily notched new all-time highs. Even as central banks turbocharged monetary expansion and inflation fears simmered, silver seemed stubbornly range-bound, struggling to break through the $30 ceiling. Meanwhile, gold soared past $2,000 multiple times, reinforcing its reputation as the premier safe haven asset. But silver? It danced between resistance and despair, leaving investors disillusioned. That inertia, according to Michael Oliver of Momentum Structural Analysis, is now over. The sleeping giant is awake. Silver's recent breakout, Oliver argues, is not just another blip or bear trap. It mirrors behavior seen only during the metal's most aggressive bull runs, 1979 and 2010, when silver catapulted to $50 in a matter of months. Drawing from over 3 decades of technical experience, Oliver points to a rare momentum shift that suggests this time we won't be stalling at $50. In fact, he believes the metal will punch through that psychological ceiling and won't even breathe until it hits $60 to $70 levels. For Oliver, this is not just a price movement. It's a structural breakout backed by months of suppressed volatility. Michael Oliver is no stranger to spotting seismic turns in financial markets. His proprietary momentum-based analytics have consistently called major tops and bottoms in everything from equities to commodities since the early 1990s. In this new analysis, he argues that silver's technicals are now signaling an aggressive multi-month rally. But silver is just one piece of a broader monetary puzzle. In this interview, Oliver also walks through the fragility of the U.S. economy, the artificial strength of equity indices, and the hidden cracks developing in leadership stocks like the Magnificent Seven. This isn't just a conversation about silver. It's a diagnosis of a financial system under pressure. If you've been waiting for the moment when silver reclaims the spotlight, you'll want to hear what Michael Oliver has to say. Don't forget to like, subscribe, and hit the bell icon to catch more deep dive interviews and sharp market analysis every week.
As far as what government does or doesn't do, that pretty much doesn't matter. There's a reality bigger than that, okay? And a lot of people think markets go down because something happens. Most markets, when they go down, have big bear trends. It's because of what already happened, built up over years. And the market is expunging itself of that error, overpricing error, assumptions that were false errors. And we've had the biggest bull market in U.S. stock market history from 2009 to 2025. And it was led by the tech area. NASDAQ 100 went up 18-fold in 15 years. S&P went up about 8 or 9-fold. So clearly NASDAQ 100 tech sector was leader. But you say, well, that was a good, strong economy. Well, of course, Trump would admit that because most of the presidents during that time were Democrats. So you look at an M2 chart, Federal Reserve money supply. It's vertical, okay? And basically any 10-year period you pick going back to the 1950s, the money supply went up 90 some odd percent, almost doubled in quantity. Okay, that means given the greater quantity, it has less real buying power. And sure enough, since I was a kid and the loaf of bread was 20 cents, now it's, 10 times or 15 times that. Is it because we have a wheat drought? No, it's because of the ongoing degradation in the real value of the money units, not just dollar, but euro, yen, you name it. So that's a major factor. And these things are in play. So as far as the economy goes, I think we're at one of those points now where the bubble is starting to break, stock market. We gave a sell signal for the S&P in early January. That was just short of a high it made in February, and then it dropped hard into April. We know that in any trend, there are counter-trend rallies. But when it was on its way down to 4,800 price level, which was our target for a bounce, not a bottom, a bounce. The bounce has been bigger than we thought it might be because it went up and made a new high. But that was a level where we thought there would be support, and lo and behold, the crowds came in. We point back in our reports recently that we've been around since 1992, but in 2000 dot-com top, MSA called the top in January. But golly, if you look at the price chart of the S&P, it made higher highs in March after we said sell in January. There was a sharp drop, then it came back up in March, and it labored all year, comfy, either side of our get-out point. Finally, in 2001, it started to cave, and in 2002, collapsed. In fact, the NASDAQ went down 82%, a near wipeout. Okay. Then 2007, another arduous top. Close of 2006, the S&P was about 1350 in price. We projected that we'd go higher in next year into 2007, and we had a target for a top. We defined it as 1550 to 1600. Now, I'm throwing out numbers here. Let me tell you what those are. 1550 was the old high that the market had made in the year 2000. So it was at 1350. We said, we're going to go back to the old high. We're going to take it out. And that's where you're going to top. Well, in May, we went up over 1550 by about 2-3 points, matching the high in 2000. And they sold it. Sharp sell-off into the summer of 2000. This is all during the building mortgage crisis that was increasing in its lethality. Okay. Not recognized by the Federal Reserve, but nevertheless, it was going to happen. Then in September, the Fed cut rates. September 2007, right in the middle of the month, was a surprise rate cut, 0.5 point. Even though Bernanke back then said, no problem with the mortgage market, it's under control. Well, why'd you cut rates then? Okay. Market went up into October, stopped at 1576, precisely in the middle of our target zone. That was it. Arduous. In other words, tops in the stock market are often very time-consuming and teasing. Often with, even once momentum breaks, prices, no, I'm going to go for more. It doesn't, but it makes that new high. I think that's exactly what we're doing now in the U.S. market, is we've teased out the high of early this year. And by the way, if you look through the market more carefully, not just the S&P or the NASDAQ, many sectors, many key symbols, including the Mag 7, aren't making new highs. A couple of the Mag 7 are, but most of them are way off the highs now. So the leadership has been decimated. And it's not exactly what the S&P and the NASDAQ charts seem to be saying. We think it's the top. It's important for silver and gold. Because when that money flows out of there, and it's already begun to, seeking an alternative place, monetary metals will be the prime area. Gold is already reflecting that, and we think that silver is about to take control and vastly outperform gold. And probably much of that you're going to see in the next 5 to 6 months.
In the first part of the interview, Oliver unpacks the growing dissonance between economic fundamentals and market behavior. While major equity indices flirt with all-time highs, underlying momentum metrics, especially in the NASDAQ and S&P, are beginning to deteriorate. He revisits past tops, like those in 2000 and 2007, to illustrate how long markets can tease investors before collapsing. Central banks may still be trying to micromanage rates and liquidity, but Oliver insists there's a larger force at play: the long-term momentum exhaustion of a 15-year bull market. When momentum breaks, even if prices linger near highs, the next move can be abrupt and brutal. What does this mean for precious metals? According to Oliver, the ongoing transition away from overvalued equities is already redirecting capital toward alternative stores of value. Gold has been an early beneficiary, and now silver is catching up. This sets the stage for the next part of the discussion, where Oliver breaks down the technical structure behind silver's recent surge, how it's outpacing gold, and why momentum traders are starting to treat $50 not as a ceiling, but as a floor in the making.
I guess really what is driving the momentum with the silver price?
Well, it ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miners. Renewed meaning that for prior couple of years, they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways, basically, capped at around 2000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Okay. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024, in other words, a handful of months after our signal, and got up it was at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May, okay, and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways during that time. Dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that. Went from 35 to 27.50. Much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're at 37, either side of 37 for the last several weeks. That process in price where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube, where momentum readings just kept zigzagging but downside in this very clear technical tube, parallel channel. In June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high, wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It's like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at it as a stupid price chart, is all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be.
Do you see anything that could cause a significant
I
pullback?
don't think anymore. I think that occurred over the last year, as I explained, from May of last year up through June of this year. There was this momentum corrective process. And if you saw our charts, you would see what I was talking about. Momentum was revealing something that you couldn't see it on a price chart. On a price chart, you saw erratic behavior that seemed to be trendless, yet net on balance, it was really sideways, either side of about $32, up, down, up, down, up, down. Momentum was building a structure, what we call a structure, meaning a definable chart pattern, in this case, a perfect parallel channel that spanned an entire year when momentum was correcting from pretty high levels down to neutral levels. And then it said, okay, out of here. And it's out of here. So I suspect basically about every month going forward, we're going to see silver dramatically higher than the prior month. And I think we're not going to pause at 50. Anybody who's waiting to sell it up there again, I think is going to get bulldozed. But I think this is not a behavior pattern that's unusual for many markets, not just silver, where after a lengthy upside where there's been arm wrestling a lot of the way, up and down, confusing a lot of people. These things happen. That's reality. Markets ebb and flow. They have waves of profit taking. The question is, which one is real, meaning sustainable? None of them have been for silver. None of them have been for gold, sustainable on the downside. Even that collapse we had in April, which took it from 35 to 27.50, was back up in the 30s in a heartbeat and then new highs within a month. Okay, so you've got, if you're invested in silver, don't look at the day-to-day stuff. Even looking at price itself can be delusional, but at least look at the longer-term trend and you'll see what I'm talking about, that this arm wrestling process doesn't go on forever. And most bull markets, you get a point where you go whoosh, and people are shocked by the sudden change in the demeanor of the market. It's not what they expected because they've been trained by the market action prior to expect this continued doubt process, going up yet in doubt. And then suddenly there's a jolt, and if you're not there, you miss it. And because it won't give you opportunities to enter. As far as we're concerned, basically all the opportunities to enter are well below us. But you better get in soon, because if we're correct, and I think we are, you're going to see this type of action, which will be surprising. And I bet it's correlated to certain other markets doing certain other things.
Michael Oliver's analysis of silver is both historical and highly technical. He recalls the explosive surges in 1979 and 2010, when silver leapt from consolidation to vertical acceleration, doubling or tripling in a matter of months. The current setup, he says, is technically more potent. For the past year, silver has been trapped in what seemed like chaotic volatility, moving between $27 and $35 in unpredictable bursts. But on a momentum chart, that chaos formed a textbook parallel channel, a corrective structure that quietly prepared the market for breakout. In early June, silver burst through that momentum channel, even before price action confirmed the move. For seasoned technicians like Oliver, that's a flashing green light. What's particularly striking is Oliver's view that this breakout phase is not a peak, but a beginning. He sees silver doubling in performance relative to gold over the next 5 to 6 months. This isn't hyperbole. He's basing this on structural momentum shifts that typically precede aggressive moves in commodities. Silver's recent pattern of violent rallies followed by equally sharp pullbacks is not a sign of weakness, but an indication of energy buildup. The correction from $35 to $27.50, which occurred in just 2.5 days, was swiftly reversed. Within a month, silver was back near $37, a level it has now tested multiple times, showing both resilience and potential energy. From a macroeconomic standpoint, Oliver emphasizes that real inflation is far more entrenched than policymakers admit. The price of basic goods has risen tenfold since the 1970s, not because of supply issues, but because of sustained monetary debasement. When adjusted for that decay, silver's previous highs around $50 look more like $300 in today's dollars. So, when analysts or investors call $50 an all-time high, they are missing the forest for the trees. In Oliver's words, those levels were just phantom highs, brief, unsustainable spikes in thin trading. This time, the move looks more durable, and $60 to $70 may be just the first plateau in a larger bull phase. He also cautions investors against focusing on day-to-day price swings or traditional technical charts. In a market defined by structural change and liquidity rotation, waiting for perfect entry points can be fatal. If Oliver's momentum signals are accurate, the biggest mistake would be hesitation. The silver market, he argues, has already absorbed its downside correction. The opportunity is no longer in buying the dip, it's in riding the wave before it escapes reach. And given that silver's supply-demand dynamics remain tight, especially with industrial and monetary demand colliding. The setup is more bullish than it's been in decades. As capital flees equity markets bloated by unsustainable valuations and weak breadth, silver stands to benefit disproportionately. Gold may be the standard bearer, but silver is the high beta play, the metal that catches fire when capital needs a new home and inflation hedges become urgent. If you're holding silver, Michael Oliver's message is clear: stay the course. And if you're not in yet, time is short. Get informed, get positioned, and don't let this moment slip past. If Michael Oliver is right, and history suggests he just might be, then silver is on the cusp of its most explosive move in decades. This isn't just about technicals or charts, it's about a structural shift in global capital, inflation realities, and the end of easy money. Don't sleep on silver. If you found this analysis valuable, give this video a thumbs up, subscribe for more high-level market breakdowns, and hit the bell icon so you don't miss the moves before they happen. Drop a comment below. Where do you see silver heading this year? Thanks for watching, and see you in the next one.